Artificial intelligence has become one of the most polarizing topics on the internet. Some see it as the biggest financial bubble in history, while others believe it's the most significant technological breakthrough in decades. I put this video off for quite a while because it felt like every conversation eventually circled back to AI. But the longer I watched the debate unfold, the clearer it became that both sides were focused on the wrong question. Eventually, I reached a point where staying out of the conversation didn't feel like an option anymore. So here's the discussion I had been putting off, because the uncomfortable reality is that it doesn't matter which side turns out to be right. They're both fixated on the wrong metric. The entire debate revolves around user growth, adoption rates, revenue, and how many people are using these tools. In other words, everyone's watching demand. The problem is that demand is also the easiest part of the story to misread. It's shaped by headlines, fueled by narratives, and often reflects whoever has the loudest voice rather than what's actually happening. But there's another side that rarely gets the same attention, even though it offers a far clearer view of what's really going on beneath the surface. Professional investors have relied on that overlooked side for centuries. Instead of chasing demand, they watch supply. The reason is simple. Demand can be exaggerated, distorted, or temporarily propped up. Supply is different. It requires real capital, real investment, and real commitment, making it far harder to fake. This year alone, the world's largest technology companies are expected to invest roughly $725 billion into artificial intelligence. Most people hear a number like that and move on without giving it much thought. But $725 billion isn't just enormous. It's almost impossible to truly comprehend. To put that into perspective, imagine spending $1 million every single day, beginning on the day Jesus was born. You could keep spending through the rise and fall of empires, the Renaissance, both world wars, and continue all the way to the present day without ever reaching the amount big tech is projected to pour into AI this year alone. That works out to roughly $2 billion every day, more than $83 million every hour, or around $23,000 every second. By the time you've reached this point, those companies have invested well over $3 million. We've never seen investment on this scale before. But as the old saying goes, history may not repeat itself, yet it often follows a familiar pattern. The real question isn't whether AI will transform the world. It very well might. Financial bubbles don't require bad technology. More often than not, they're built around innovations that genuinely change the future. A study covering 175 years of technological innovation examined breakthroughs ranging from the automobile to television and the internet. Out of 51 major technological advances, 37 were followed by large, speculative financial bubbles. As billionaire investor George Soros once said, "Stock market bubbles don't grow out of thin air. They have a solid basis in reality, but reality is distorted by a misconception." History keeps producing the same pattern, which is why experienced investors spend less time chasing demand and far more time tracking supply. Following that trail leads to a framework built on one of the oldest principles in economics, dating all the way back to Adam Smith in the 18th century. The increase of stock, which raises wages, tends to lower profit. When the stocks of many rich merchants are turned into the same trade, their mutual competition naturally tends to lower its profit. And when there is a like increase of stock in all the different trades, the same competition must produce the same effect in them all. The character looks out the window one last time as the sun rises on the city. Following that trail leads to a framework built on one of the oldest principles in economics, dating all the way back to Adam Smith in the 18th century. The increase of stock, which raises wages, tends to lower profit. When the stocks of many rich merchants are turned into the same trade, their mutual competition naturally tends to lower its profit. And when there is a like increase of stock in all the different trades, carried on in the same society, the same competition must produce the same effect in them all. When Adam Smith talks about stock, he isn't referring to the stock market. He's talking about capital, the money and productive assets flowing. Put into modern terms, his point is straightforward. High returns attract investment. More investment brings more competitors. As competition increases, those attractive returns begin to disappear. Over time, everyone ends up earning less than they expected. That idea eventually evolved into what investors now call the capital cycle theory. It focuses on how capital moves through the supply side. Once you understand how this framework works, you'll begin to recognize the same pattern behind many of the biggest market bubbles in history. The capital cycle unfolds in 4 stages. It begins with the flood. A breakthrough technology emerges, and capital rushes in to capture it. Next comes the boom. Investment keeps accelerating. New competitors enter the market faster than demand can absorb them. Then comes the collapse. The very capacity built during the boom overwhelms the market. Profits shrink, companies fail, and the industry is forced to consolidate. Finally comes the inheritance. Capital retreats, early builders disappear, and the assets they created are acquired at a fraction of what they originally cost. The idea is surprisingly simple. Long-term returns are shaped far more by supply than demand. The most attractive opportunities usually appear when capital is leaving an industry, not rushing into it. But before we dive into those examples, here's billionaire investor Howard Marks explaining why markets have a habit of repeating the same mistakes. Let's go back to one of the earliest examples. Picture Britain in the 1830s, right in the middle of the Industrial Revolution. Then the railway arrived, and almost overnight, it changed the economics of transportation. Wherever opportunity appeared, capital wasn't far behind. This was the flood. Money poured into anything connected to railways. Shopkeepers, clergymen, and ordinary families all rushed into railway stocks. At its peak, railway investment accounted for nearly 7% of Britain's entire economy. Parliament approved 272 separate railway acts. Rail lines overlapped, unnecessary projects multiplied, and tracks stretched into towns that could never generate enough traffic to justify the investment. Reality eventually caught up. By 1850, the railway boom had collapsed, and Britain's railway index had lost more than half of its peak value. Then came the final stage, the inheritance. The original investors were wiped out, but the railways they had financed didn't disappear. The biggest winners weren't the people who fueled the boom, they were the ones who stepped in afterward and acquired those assets. Money rushed toward the industry's brightest opportunity, convinced the highest returns would follow. But as more capital poured in, competition intensified. In the end, the very investment that fueled the boom became the reason it collapsed, while the infrastructure created extraordinary opportunities. It's easy to look at stories like this and assume they belong to another era, but the underlying pattern hasn't. Fast forward to the late 1990s. After the United States overhauled its telecommunications laws in 1996, an enormous wave of capital poured into fiber optic infrastructure. Telecom companies laid more than $500 billion worth of fiber optic cable, stretching nearly 80 million miles across the United States and beneath oceans. But eventually, enthusiasm gave way to reality. Roughly 85% of that fiber remained completely unused. Bandwidth prices plunged by around 90%. The Nasdaq lost more than 70% of its value. And Corning saw its stock collapse from $100 to $1. The technology itself wasn't the problem. In fact, the internet went on to transform nearly every part of modern life. The mistake was the timing, the sheer amount of capital invested all at once. Investors dramatically overestimated how quickly demand would catch up. Years later, however, that excess fiber became the foundation for cloud computing, streaming services, and the digital economy we rely on today. The pattern repeated itself in countless industries throughout history. Time after time, investors became convinced they had discovered a once-in-a-generation opportunity. Capital flooded in, expectations soared, supply expanded far beyond what demand could support, and returns eventually collapsed. The details changed from one era to the next, but the underlying cycle remained remarkably consistent. Where does artificial intelligence fit into this pattern? To answer that, we first need to understand what today's AI industry actually looks like. And to do that, we have to examine the competitive landscape through the lens of the capital cycle. The AI industry is often described as a race for better models, but that's only part of the picture. Behind every breakthrough is a massive physical infrastructure. Data centers, advanced chips, networking equipment, and electricity form the foundation of the ecosystem. While software captures most of the attention, it's this underlying infrastructure that absorbs the overwhelming majority of the capital being invested today. This is why the companies at the center of the AI boom aren't just developing software. They're engaged in one of the largest infrastructure build-outs. Every major player is racing to secure more computing power, expand data center capacity, and deploy the chips needed to train sophisticated models. The scale of that investment is unprecedented, and it's happening at a pace few industries have ever experienced. At first glance, it seems like a straightforward success story. Demand for AI products keeps climbing, and companies continue announcing record-breaking investments. But history suggests that this is exactly the point when investors should start asking more difficult questions. The critical question isn't whether artificial intelligence will reshape the world. It almost certainly will. The real question is whether today's level of investment is expanding even faster than future demand can realistically absorb. Capital cycle. Theory asks whether too much capital is chasing the same opportunity at the same time. To answer that, we need to follow the money. We have to examine where capital is actually flowing. The first place to look is the companies supplying the infrastructure. While firms like OpenAI attract headlines, they're only one piece of the ecosystem. Beneath them is an extensive supply chain of chip designers, manufacturers, networking companies, cloud providers, and data center operators. These are the businesses absorbing the bulk of today's investment, making them the most important place to begin our analysis. At the center of that network sits NVIDIA. While the company is widely recognized for designing the GPUs that power modern AI models, its role extends far beyond selling chips. NVIDIA has become the primary supplier of the computing infrastructure on which the entire AI industry depends. As demand for AI accelerated, its revenue, profits, and market value surged at a pace rarely seen in corporate history. To understand why NVIDIA has become so dominant, recognize that modern AI models require an extraordinary amount of computational power. Those workloads depend on specialized chips capable of processing massive volumes of data simultaneously. Over the past decade, NVIDIA built a commanding lead, making its GPUs the industry standard for developing advanced artificial intelligence. That leadership translated into explosive financial growth. NVIDIA's revenue climbed from $27 billion to well over $130 billion just 2 years later. As investors rushed to capitalize on the AI boom, the company's market value soared, making it one of the most valuable businesses. From a capital cycle perspective, however, NVIDIA's success tells only part of the story. Strong profits and soaring demand naturally attract more investment, but that's precisely how new competition begins. As the opportunity becomes too large to ignore, rivals accelerate their own spending, and the industry's supply capacity starts expanding. That's exactly what we're seeing today. Nearly every major technology company is investing aggressively in AI hardware. Firms that once depended on NVIDIA are now developing their own custom chips to compete for a share of this growing market. History suggests that dominant companies rarely remain unchallenged. High returns create powerful incentives for competitors to enter. The same forces that drive extraordinary profits during the early stages often lay the groundwork for lower returns later on. That brings us to the next key company in the AI supply chain, TSMC. Unlike NVIDIA, TSMC doesn't design chips. Instead, it manufactures the advanced semiconductors that power nearly every leading AI processor. Whether the chip is designed by NVIDIA, AMD, or Apple, there's a good chance it ultimately comes off a TSMC production line. The company has become the indispensable manufacturing backbone of the entire AI industry. Manufacturing cutting-edge AI chips is one of the most difficult engineering challenges in the world. Building advanced fabrication plants requires enormous capital, years of expertise, and an exceptionally complex supply chain. The important question is whether the surge in investment will produce more manufacturing capacity than the market can profitably absorb. History shows that when an industry experiences extraordinary returns, expansion rarely stops at exactly the right point. Every major technological revolution begins with genuine innovation, followed by a surge of investment to expand capacity. Knowing when expansion crosses the line from meeting future demand to creating excess supply is the question for investors today. That's the question investors must ask, not just about TSMC, but about the entire semiconductor industry supporting the AI boom. The same dynamic extends well beyond chip manufacturing. Companies supplying networking equipment, memory power systems, and cooling technologies are experiencing an unprecedented surge in demand. Every additional AI data center requires an enormous amount of supporting hardware, triggering a wave of investment across nearly every layer of the industry's supply chain. One company that stands out in this part of the ecosystem is Broadcom. While it doesn't receive the same level of public attention as NVIDIA, its networking chips and custom silicon play a critical role in connecting the massive clusters of GPUs that power today's most advanced AI systems. As AI infrastructure continues to scale, efficient communication between those chips has become just as important as the computing power itself. Broadcom's recent growth reflects the same trend we've seen across the rest of the AI supply chain. As cloud providers invest billions to expand their infrastructure, demand for the company's networking products and custom AI chips has accelerated sharply. The business continues to benefit from the industry's rapid expansion, but it also illustrates a familiar pattern. Exceptional returns are attracting unprecedented levels of investment. This is exactly how the capital cycles unfold. The stronger the opportunity appears, the more companies commit resources to capturing it. Suppliers expand production, customers invest heavily to secure future capacity, and competitors race to avoid being left behind. For a time, everyone seems to benefit. But history suggests that this phase rarely lasts forever. That brings us to the companies financing much of this expansion. The hyperscale cloud providers, Microsoft, Amazon, Google, and Meta, are investing at levels rarely seen, pouring hundreds of billions of dollars into new data centers, AI chips, networking infrastructure, and the energy systems required to support them. Together, they're driving one of the largest capital spending cycles the technology sector has ever experienced. The scale of these investments is difficult to overstate. Every quarter, these companies commit tens of billions of dollars to expanding AI infrastructure, with annual capital expenditures reaching levels that would have been almost unimaginable just a few years ago. The underlying assumption is clear. Future demand for artificial intelligence will be large enough to justify the enormous capacity being built today. From the standpoint of the capital cycle, this is the moment that deserves the closest attention. Booming demand can certainly justify higher investment, but history shows that markets often push far beyond what future returns can support. The challenge isn't determining whether AI will keep growing. It's determining whether today's wave of capital spending is expanding faster than the market's long-term demand. The numbers alone are staggering. Between 2024 and 2028, the largest technology companies are expected to invest roughly $1.6 trillion in AI infrastructure. That's an extraordinary amount of capital flowing into a single technological revolution. The question is no longer whether investment is happening. It's whether all of that new capacity will ultimately generate the returns investors are expecting. This is where the capital cycle offers a very different perspective from the one most investors focus on. Instead of asking whether AI has a bright future, it asks whether the industry's expansion is creating more supply than future demand can realistically absorb. History has shown time and again that these are two very different questions, and the answer to one doesn't automatically determine the other. So how do we know when that line has been crossed? The answer lies in comparing the capital flowing into the industry with the value it's actually creating. If investment continues to outpace revenues and profits, history suggests the imbalance will eventually correct itself. That's exactly what we'll examine next. The first warning sign is already visible. While investment in AI infrastructure has been rising at an extraordinary pace, the revenue generated from AI services remains comparatively small. Much of today's spending is being driven by expectations about future demand. That doesn't necessarily mean those expectations are wrong, but it does increase the importance of getting the timing right. That doesn't mean the AI boom is destined to end the same way previous investment manias did. Every cycle has its own outcome, but history does show that periods of extraordinary capital spending are often followed by lower returns once competition increases. That's why investors should pay just as much attention to the industry's economics as they do to its technological progress. For long-term investors, that's a crucial distinction. A technology can transform the world and still turn out to be a disappointing investment. Financial markets don't reward innovation alone. They reward businesses that generate returns exceeding what investors have already priced in. None of this means investors should avoid artificial intelligence altogether. It means they should be selective about where they invest. As every capital cycle has shown, the biggest winners often emerge only after the initial wave of investment has run its course. Looking back at every example we've covered, from the railways to fiber optic networks and now artificial intelligence, the same principle keeps resurfacing. The greatest opportunities usually begin with genuine innovation, but the largest investments often arrive only after expectations have already become widespread. That's when disciplined analysis becomes far more valuable than following the crowd. Capital cycle theory provides a framework for identifying industries where capital is flowing too freely and competition is intensifying. If history teaches us anything, it's that the biggest investment opportunities emerge when expectations have reset. Artificial intelligence may prove to be one of the most important technological breakthroughs of our time, but history suggests that successful technologies and successful investments are not always the same thing. The better question is whether today's prices already reflect that future success. Investors who can separate technological progress from investment expectations are far more likely to make sound long-term decisions. If you can learn to recognize those cycles, you'll see opportunities long before they become obvious to everyone else. Thank you for watching Financial Cycles, and I'll see you in the next one.